Good morning and welcome to Techstep's Q1 2021 presentation. My name is Jens Haviken and I am the CEO of Techstep. Together with our CFO, Marius Drefvelin, I'll take you through our Q1 results, as well as walk you through our acquisition of the software company Famoc, which we announced today. This presentation is pre-recorded and we will host a Q&A session later today at 10 a.m. Information on how to participate in the Q&A session will be given at the end of this presentation. You will also find the details on our website. The highlights of the quarter. Gross profit continues to grow and results are stable despite a slow quarter. Q1 gross profit of 114 million was up from 80 million in the first quarter of 2020. An EBITDA adjusted of 13 million compared to 12 million of the same period last year. We signed 8 new managed mobility services contracts in Q1. With an estimated value of 15 million, adding about 3,300 managed devices. We are also very pleased to note the honorable mention of Techstep in Gartner's recent report, Magic Quadrant for Managed Mobility Services. Last but not least, we have agreed with the owners of Famoc to become a part of the growing Techstep family. Techstep is purpose-built to manage mobility solutions. And our ambition is to become the leading managed mobility services provider in the Nordics. We have, over the last few years, focused all our time and effort to seize that position. We have acquired and integrated several companies on the way and have invested heavily in developing our own software and IP. We have taken huge steps from a legacy as a traditional mobile reseller to become the managed service provider we are today. And we are positioned stronger than ever to reach our ambitions of being number one. As said, we are aiming at becoming the leader of managed mobility services in the Nordics. And to have more than 1 million devices under our management by 2025. To reach that target, we need to work in several areas. First, we need to move our existing customers from traditional products and services to managed services contracts. This is our primary action to succeed with our ambition in Norway, where we are an established player in this area already. Secondly, we need to win more new customers with our value proposition. This is in particular true in our markets outside Norway. M&A will continue to play an important role in our journey. In particular to strengthen our IP and software platform, as well as being a vehicle for us to expand into new markets. The Famoc acquisition is a good example of what type of companies we look for. Our main area of focus is the deskless worker, a long overlooked group of people when it comes to technology and digitalization in general. About 80% of the total workforce don't sit at a desk. And we believe mobile technologies provide a great opportunity for these users, their organizations, and for Techstep. We have several strong examples on how our customers and their deskless workers embrace mobile technology to improve their work life. Bus drivers that use tablets for tasks such as damage reports, timetables, and learning in the field. We have electricians who document their work and invoice customers between assignments. And employees in the retail sector who are able to spend more time with their customers on the shop floor than they do in the office. Techstep has a fantastic customer base with strong opportunities for additional sales. And we see that more and more customers value our Nordic presence. In Q1, we added 3 new MMS contracts in Denmark. And this shows there are opportunities for building new enterprise customers beyond Norway and Sweden. In total, we signed 8 new MMS contracts with important customers. In addition to representing 3,300 new managed devices, it proves that we offer mobile services that are valued by large Nordic companies. It is always exciting to talk about new customers and their stories. And here are a couple of examples of newly signed contracts. Vy has been a customer of Techstep in both Norway and Sweden for some time, and we are very pleased to add further users and services to our relationship with Vy. The new MMS solution is to be developed and managed by Optidev AB, Techstep's Swedish acquisition from October last year. Using our own software, through mobile, as the platform for Vy's new customized MMS solution. Bertel Osten is another long-time customer of Techstep. This new agreement will provide Bertel Osten with an advanced and comprehensive voice and contact center solution that will allow for better customer dialogues across multiple channels such as voice, chat, SMS, emails, and social media. The solution is available across multiple mobile devices and locations, ultimately bringing an even better experience for Bertel Osten's employees and customers. Techstep's customer offering is comprehensive, concise, and more relevant than ever. We have today a clearly defined stack of services that can be bundled together to best fit each customer's needs and thus increase value creation both for our customers and our shareholders. The ability to package our services in customized service agreements is an important value driver that is expected to increase our recurring revenue streams as well as gross profit per unit. Going forward, it is important that we help existing customers further on their mobility journey and cover the needs that arise and seize the opportunities that come. We will therefore continue to develop or acquire new services that will further increase the value for our customers. Gartner has defined a category for the type of services Techstep offer called Managed Mobility Services. In their latest report, they have given Techstep an honorable mention, recognizing Techstep as a Nordic MMS provider with a complete MMS offering. We are very proud of this. We have worked purposely for several years to develop solid services in this spectrum. Gartner's analysis is very encouraging both for Techstep and our customers, because it emphasizes the important qualities that we have developed over time in order to offer our customers the best managed mobility services. I will now hand over to Marius that will take you through the financials for the first quarter.
Thank you, Jens. In the first quarter this year, revenue increased from 293 million to 306 million. More importantly, however, gross profit increased by 42% from 80 million to 114 million. This relates to an increase in our leasing portfolio and contributions from the acquisitions made in the fourth quarter last year. EBITDA adjusted increased from 12 million to 13 million. The increase in gross profit was offset by increased operational expenses from acquisitions and continued reinvestments. There was an increase in depreciation as a result of growth in leased-out hardware. We have a prudent approach on the residual value of the assets, and the leasing portfolio will start to mature towards the end of next year. Amortization on intangible assets relates to acquisitions and development costs. Amortization is non-cash and completed by 2026. The net interest-bearing debt decreased to 152 million. The net debt mainly relates to acquisition loans and seller's credit from acquisitions made last year. The gross profit for the last 12 months increased from 378 million in the fourth quarter 2020 to 412 million in the first quarter of this year. There was an increase in the leasing portfolio as we continue the transformation from traditional one-off deliveries to recurring revenue. Moreover, there was an increase in owned software and advisory and services driven by acquisitions. All of these are important drivers for gross profit going forward as we continue to focus on rolling out our own managed mobility services offering. This offering is a solution including financed mobile devices, connectivity, service and support, and most importantly, our own software. This will boost the value for our customers by reducing administration costs and increasing the flexibility and security related to having a mobile workforce. Here we see the development in pro forma gross profit and EBITDA adjusted. This includes our acquisitions we made last year for the full period. Since the first quarter last year, we've had an increase in the profitability, mainly due to the following key drivers. First, a positive contribution from our own software, advisory and services, and growth in the leasing portfolio, impacting both gross profit and EBITDA. Second, the Optidev acquisition with underlying improvements. In this quarter, however, we had increased costs relative to the gross profit increase, thus reducing the profitability. We remain firm on our focus to increase profitability in the long term through operational leverage and an increase in software and IP-led revenues. If we look at the development in ARR on our own software, we had a 78% increase in Origo users from the first quarter last year to this year, and moreover 11% growth compared to the previous quarter. As per the first quarter this year, the total ARR was 66 million, of which MMS-related ARR comprised 36 million from our Origo and True Mobile software. As we continue to focus on winning MMS contracts, this will drive the ARR growth. In the quarter, we maintain our solid balance sheet with 44% equity ratio. Tangible assets include leased out hardware of 172 million and other right-of-use leasing assets of 36 million. The net interest-bearing debt was 152 million, of which 57 million is an acquisition loan and 70 million is seller's credit from the acquisitions of Optidev and eConnectivity in the fourth quarter last year. Other current liabilities include deferred revenue on hardware leasing contracts of 128 million. The cash flow from operations was 94 million. This includes a decrease in net working capital of 81 million, mainly due to reductions in accounts receivable and inventory, as well as increase in deferred revenue from the leasing portfolio. Net investments include leased out equipment of 74 million, development capex of 7 million, and proceeds from leasing assets of 7 million. Net financing of 19 million includes proceeds from overdrafts and cash pool of 31 million, offset by lease repayments of 4 million and repayment of borrowings of 8 million. With this, I will hand it back to Jens.
Thank you, Marius. We will now walk you through our latest development on M&A, the Famoc transaction. I will start to recap what we are looking for when it comes to M&A. We divide our M&A strategy in 3 categories. The most important one has been to identify companies that will enhance our software and IP capabilities. The 2 acquisitions we did last year, Optidev and eConnectivity, were both in this category. We also look for targets where we can get into new markets. This can be more traditional resellers, which becomes a foundation to roll out our MMS services. We also look for companies that has a similar business model as ourselves, where we can increase our customer base and drive the number of managed devices towards our target. We have previously talked about what we need to do in order to achieve our ambitious goal of managing 1 million devices. The Famoc acquisition checks all the boxes. It will help us to speed up conversion of existing customers to managed services contracts. It will also help us to win new contracts as we improve our competitive edge. And of course, it is an acquisition that supports our most important category, IP and software. Last but not least, it opens up new markets for Techstep's MMS offerings. Famoc is a Polish software company headquartered in Gdansk. They deliver industry-leading software for managing and securing mobile devices, often referred to as Enterprise Mobility Management Systems, shortened EMM. They have 44 employees who serve enterprise customers and partners in several European countries. Their main route to market is through channel partners and distributors. The total enterprise value of the deal is 47 million Polish zloty or 103 million Norwegian kroner. This acquisition makes Techstep an all-in-one MMS provider. Famoc will strengthen Techstep's service stack with their software, which in turn will lead to enhanced value for our customers and increase gross profits for Techstep. Famoc is the missing piece in our puzzle, and with their added capabilities, we are able to deliver a complete service stack based on our own IP. We believe that this acquisition will give us a competitive edge, which will be hard to match for the other MMS players. Imagine yourself as one of Techstep's sales representatives. You will now have a very strong value proposition for your customers. You can now offer them a complete, automated and fully integrated MMS platform, which gives users and enterprises control, security, compliance and lifecycle management. All within one dashboard, all at a lower cost. In the other direction, we also see great opportunities in taking Techstep's extensive know-how in mobility and bring that to Famoc's existing partners and customers in Europe. In short, we believe the combined forces of the two companies will see significant MMS opportunities in a vastly expanded market, with a serious competitive advantage. The acquisition of Famoc is expected to improve several of Techstep's key financial metrics. Famoc will increase Techstep's ARR by approximately 40%. Software's share of gross profit will increase from 12 to 17%. And we will see a significant increase in segment gross profit by moving to in-house platform management software. Famoc currently has an installed base of 850,000 devices, representing a significant cross-selling opportunity for Techstep. And also, we will be able to provide an even more competitive offering towards our existing customers, thus accelerating our growth. We will finance the acquisition with a combination of an equity raise backed by our main owners and a credit facility. We will provide more information on this in the near term. So, in order to sum up and taking a look ahead. Going forward, we are targeting strong growth with our MMS offerings. We intend to double the number of users on our cloud solution Origo and sign more than 30 new MMS contracts. When it comes to financials, we believe our gross profit growth will be in line with what we have said before, and the gross profit to EBITDA conversion will rebound to our targeted levels. We expect development capex to be higher than the long-term ambition, driven by the need to modernize our existing business systems to increase efficiency and scalability and improve profits long-term. So, to summarize, gross profit growth continues and results are stable despite a slow quarter. We signed 8 new managed mobility service contracts in Q1, and Gartner has given Techstep an honorable mention in the latest report. We are strengthening Techstep's MMS capabilities and unlocking European expansion by acquiring the Polish software company Famoc. And we continue to target strong MMS growth in 2021. With that, we conclude today's presentation. As mentioned earlier, we will host a digital Q&A session at 10 a.m. The link to join is shown on screen. You will also find a link on techstepasa.no and in the presentation deck. If you have any questions you want to address during the Q&A session, please send us an email at ir@techstep.no. Thank you for listening in and have a nice day.